Vinod Karki, Head of Strategy with ICICI Securities, joins us. Let's connect with him to understand what he makes of the current market. So, Vinod, we are up 22,000 points on the Nifty. Do you think markets now are looking bloated and they're due for a correction, or this party will continue?
Hi, Nikhil. I think this fast rally, if you may call it, from 17,000 till now, was mostly to do with what happened in March when the banking crisis started there in the US, and that kind of created an environment where people thought that domestic demand and overall demand will take a big hit. But if you look at the numbers, the high frequency data, that has not happened. In fact, relative to other economies which were really gaining traction prior to this, like China and Taiwan, they have started to fizzle out, and our fundamentals are looking better, in fact. So I think all this is resulting in this outperformance, which I think is based on the underlying trend. If you see in the GDP expansion, is driven by the investment cycle, the real estate cycle, the credit cycle, and also the profit upcycle. So I think this will continue, although I would say that valuations are now getting richer, which should limit returns from here on. That's the view, but I don't see any reason why the market should correct big time, because our observation all along has been that the underlying themes within the economy, domestic economy, were quite strong. Only the external sector was looking a little worrisome due to these banking crises. But even from markets like US and all, the underlying economy is not getting into that recession that people have been expecting for almost a year now. It is still resilient. So let's see how it pans out. But the external sector seems to be the biggest risk, while domestic investment cycle and credit cycle driven stocks should do much better.
Just wanted to flag out the flashes running for you at the bottom of the screen, talking about how India may cut solar panel import tax. It's likely to get halved to 20% versus 40% earlier, and that's the reaction you're seeing on Sterling and Wilson Solar. That stock has spiked as much as 6% as we speak. But coming back to our discussion, Vinod, one space that you've been very positive about has been real estate as well. What are the top bets there? What's the thesis with respect to real estate demand continuing despite the interest rate hikes that we have seen?
Yeah, for us, real estate is larger. So if you look at the breakup of the investment cycle, and that's what we have been talking about in our reports also, that the previous peak of the investment cycle was around 11-12. And if you just break it up, the gross fixed capital formation, almost 37% of the contribution was from real estate investments by households, basically. And that 37% till about 21 dropped to close to 25% odd. And as of now, if you see post-pandemic recovery in the economy, the GDP expansion has been led by gross fixed capital formation. But what people forget to see that if you break it up, the institution-wise, only two major institutions have been driving it up. One is the government, the central government capex. And the second one is real estate investments. We know that corporate capex has been slow, although it's bottoming out, but it's not really picking up to the extent we would have wanted it. But since the overall gross fixed capital formation is leading investment, the overall GDP growth, then obviously these two are driving this thing. So in the real estate for us is more to do with the overall income growth in the economy, because it's the second largest employer in the economy after agriculture, especially in the unorganized and informal segment. And there are a lot of allied activities, manufacturing activities, which are connected to real estate, which again, get benefit when the real estate cycle picks up. And we have seen this example of China and other countries where the real estate cycle has picked up, and it has really moved the entire lot of allied manufacturing activity. So I think that's the bigger theme for us. We have mentioned some of the real estate companies also, but it also moves the mortgage demand, the overall credit cycle, manufacturing, job income growth, and all that basically. So it's a big stimulus for the overall economy.
Okay, the transition's finally here at CEO. Rajesh Gopinathan, the outgoing CEO, has written a note to the employees before he hands over the baton on June 1st. Anisha, what's the letter reading like? Is it emotional?
It's a bit emotional because he's been a lifer at TCS, right? So obviously after 20 plus years, he's stepping out of TCS. So of course, a bit of a emotional, touch coming in there. But nonetheless, even if you look at the numbers, it backs the performance, right? Of course, he's talking about how he's wishing Kriti the very best as he charts on the way. They're very confident of reaching that $50 billion mark as far as the company's revenue is concerned. He says that the company's best days are going to be, are going to come going forward. So the best is not over yet. They're watching out for those days as well. And in the world of AI and automation, he says that TCS has always managed to stand out given the fact that they have been very nimble, etc. In fact, if you look at the data as well, under his helm, the company managed to add almost $69 billion worth of market capitalization. It, of course, stands at around $143 billion now. So quite a bit of addition there. 200,000 worth of crores paid out as dividends as well as buyback. They've added almost 60 customers in the $100 million range as well. Cash conversion has been solid under his, leadership as well. So, of course, quite a bit of improvement that we have seen. But he leaves the, company in a very rocky stage when the macroeconomics are posing as a bit of a headwind for the entire sector. So, Vishal, Mr. Karki, in context of that, what's your take on IT as a sector? And if at all you had to take top bets, what would those be?
Yeah, so IT has corrected quite a bit, and it is getting into an interesting zone. But our experience with equities has been that valuation seldom results in outperformance. It's only the excitement around growth. And when you start seeing growth upsides, growth surprises, and even if things are expensive, they keep outperforming. So from a near-term outperformance perspective, unless you see a reversal in growth, and the growth, factors will only be, you will only be able to gauge growth when they start hiring. So the hiring numbers and the outlook in terms of growth, if you start seeing upgrades there, then from a outperformance, but if you were to just look at from a valuation perspective, long-term perspective, things are starting to get better here. But as I said, equities seldom work on something getting cheap in the short term, obviously. So unless you have growth catalysts for IT sector coming in, it will be very difficult for these companies to outperform. The valuation also has not become so cheap that it's below long-term average. It's still around that or a little above average kind of number.
Do you think best of the gains in banks are over? Credit cycle is almost midway. NIMs are not going to expand now. If at all, slowdown I think is there in a lot of big sectors like power, steel. Do you think one should lock some gains in banks?
So I think credit cycle, if I look at from a corporate releveraging cycle, I don't think it has even started. So retail has been sustained growth, so that's fine. But from a corporate releveraging or an NPA cycle, so as per RBI statistics, we are going to form a bottom in the NPA in this year, 24. So the NPA cycle is just bottoming out, while the corporate releveraging cycle hasn't even started. And that is where the whole deep cyclicality comes in, because the retail is not deep cyclical. It is more of sustainable growth, if you may call it. It continues with its robust growth. So from a cyclicality perspective, I wouldn't say that the credit growth cycle has kind of peaked out to any extent. From a corporate side, I don't think it has even started properly. So I think there's lot of runway there in terms of corporate credit cycle, and NPA cycle is just about finished. So I think it's a much longer story, I would say, the credit cycle thing. So banks, I mean, so you will have phases where they run up quite a bit, outperform, and then take a step back. But from a medium-term perspective, I think the credit cycle is still has a lot of legs to go.
Appreciate your time. Glad you could join us. Let's take a break with a